Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again John Tumazos. He's been with me a couple of times in this show. He is a very well-known mining analyst on Wall Street over many years. He's currently independently employed and running his own business, and he's continuing to do what he's really good at, and that is mining. Analyzing mining projects and the markets and all manner of, not just the precious metals, which your host is focused mostly on, but John is much involved in a number of very important global markets, and it's the very independent research.com, veryindependentresearch.com, and the name is very fitting because John Tumazos is very independent, and that's why we like to have him on the show. Thanks for joining me again, John.
Jay, it's an honor to be your guest.
It's really great to have you, and I want to have you just talk a little bit, take a minute to tell our listeners what you do, who your service is meant for, and how those who may be able to benefit from your service can avail themselves to it.
Well, certainly. Since from 1979 to 2007, I worked for large Wall Street firms. I ranked on the Institutional Investor All-American team for various metals categories, I think 43 times. And unfortunately, in June of 2007, I was working for Prudential, which shut down its brokerage division. And I just kept writing my research reports for my old institutional clients, and 31 bought my service the first year. Mm-hmm. So for 12 years, I've been publishing 19 on average detailed investment reports about precious metals, base metals, forest products, and fertilizers. Mm-hmm. And I basically operate like an institutional research boutique without a big bank. Institutions can buy my service for $25,000 a year and get all my stuff, or individuals can go to my website, veryindependentresearch.com/buy our reports and buy individual reports for $500 a piece, such as iron ore from May or Fortescue Metals from May that I'm going to talk about in our conversation today.
Right, so let's jump right into it, John. The iron ore markets have been on fire. I couldn't believe it. I saw a chart here. They were up something like 53% over the last 6 months. What's driving that market in a time when the global economy seems to be weakening?
So world steel production rose 6.2% in 2017 and rose 4.6% in 2018, where March last year, rest of world ex-China set a record. Mm-hmm. And this year, through May, world steel production is up 5%, where China is all the growth and rest of world has shrank a tiny bit this year. Mm-hmm. So the 3-year cumulative growth is 16.6%, or almost 300 million tons of steel, and a ton of molten iron, virgin iron, needs 1.6 tons of iron ore. So iron ore demand has grown about 400 million tons in 3 years. Wow. And the iron ore price bottomed at $38 in December of 2015, and the iron ore companies stopped planning new expansions. Uh-huh. The 4 large iron ore companies' mines really consist of 3 departments: the mine, the railroad, and the port. Mm-hmm. And Rio Tinto, BHP, and Fortescue, the major iron ore miners, are port constrained, and Vale has 150 million tons of extra ports, but they don't have permits to operate 62.8 million tons of their Minas Gerais output because they had 2 accidents in 2015 and in January this year that killed 19 and almost 300 people respectively.
Wow.
And Vale has a 50% owned operation called Samarco that's a JV with BHP that had the accident 4 years ago. It's 28 million tons and has not been able to restart.
Wow.
So let's talk a little bit, Jay, about Chinese demand for steel.
Yeah, that's where it's coming from, right?
Their auto sales are down 12% in the first half of this year after falling 2.8% last year. Their property market, their construction market in the private sector seems to be going sideways. They don't need to be building new steel mills and aluminum and other things and new export factories because of tariff and trade war concerns. They've taken half of world manufacturing. They're 54% of steel, 56% of aluminum, 35% of autos, and growing quickly. So crudely, China is about half of world manufacturing today, and the rest of the world's starting to starve. So the entire growth in steel demand in China, or over 100% of it if the private sector is shrinking, is public. And let me call public four things: military, civil public works like roads, thirdly, roads outside of China through Pakistan all the way west to the Mediterranean, what they call their Silk Road project.
Sure.
They want to export goods to the rest of the world, or maybe run their military like Hitler did and have a good road system. And then fourthly, they're doing all kinds of electricity and water and port and road public works projects in Africa because they want the copper and other metals and resources from Africa. So the U.S. had peak steel concrete reinforcing bar shipments in 2006 of 9.8 million short tons. China's steel output is 40% rebar, where ours is 8 or 9% rebar. They're doing about 360 million metric tons of rebar this year, or about 45 times more rebar than the U.S. Wow. Let me suggest those man-made islands in the South China Sea take a lot of rebar. Maybe they're building some military things that are going to be bunker bomb-proof because they're more steel than concrete. But it's not the private sector, it's the public sector in China that's sucking up all this steel. I have no way of knowing how much it goes up or down or sideways or continues, but it's up 10.2% this year.
Wow. It's
so
very strong.
The price was $75 before Vale's disaster in January 25th, and it's risen steadily every month. The metal bulletin price this morning for 62% iron ore is $125.77, and I like to read the Chicago Mercantile Exchange because it's in U.S. dollars, not Chinese yuan. And this morning it was $119.45. The metal bulletin price is the wide benchmark. It's up $50 since January 25th. Now, the market realized iron ore was short when Vale had their catastrophe.
Right.
And the government shut Vale down half in Minas Gerais state. But I think the bigger factor has been the 300 million ton rise in world steel demand. And then also Rio Tinto missed 15 million tons of output, and BHP and Fortescue missed a few million tons each. They had cyclones in March. So iron ore is great. And don't be confused by the aluminum or the copper or the nickel charts. That's something else.
All right, so John, with just a few minutes left, you seem to favor Fortescue as the way to play this, and if so, why? And how much do you think is left? I mean, it's hard to say how long this could go on, I guess.
So Fortescue Metals makes 58% grade iron ore for most of their sales, which 1 or 2 years ago was discounted $30 to benchmark. And Fortescue's discount shrank $15 and might be shrinking to only $10. So the iron ore price is up $40, and Fortescue's price is up $15 more. So Fortescue is a $6.42 stock today. The NASDAQ ticker is FSUMF. There also is a second NASDAQ ticker, FSUGY, that's a 2-for-1 ADR.
Mm-hmm.
The ordinary shares paid a 21-cent dividend U.S. in the December half year. They earned 21 cents U.S. in the December half year. Mm-hmm. They haven't reported their June half year yet, but they declared and paid a 62-cent dividend.
Wow.
So the stock yields 10% for the June half year. That was $75 in January, and I don't think they averaged 110 in June.
Huh. Wow.
So they also suffered cyclones, hurricanes in March, and lost several million tons of shipments. So it looks like they're going to be able to pay a $1 dividend in the December half year.
Wow.
And the stock is $6.42. Now, I do a discounted cash flow NPV model, Jay, to value the company. I use a 10.5% discount rate, an $80 benchmark.
For your numbers.
It's 125 today.
Huh. Yeah.
And my net present value model that I calculated on May 15 and haven't updated was $11.45. I'm a very conservative person.
Yeah, I know you are.
If I used $100 and a 9% discount rate, $100 for 62% benchmark instead of 80, it's 125 today. And if I used a 9% discount rate, I think I'd get a $20 U.S. target for the $6.42 stock. Now, this company is yielding over 20% dividend, annualizing the 62 cents they just paid. It's going to go up. And it's in Western Australia, which is a lovely, lovely place. If you ever want to take a vacation in Perth, it's a wonderful place. The dolphins swim next to the ocean, and there's beautiful beaches to the south of Perth where Alcoa exports alumina. Beautiful white sandy beaches. And this company has $13 a ton direct cost for iron ore, even though the price is $125 today.
Wow.
And their balance sheet is normal. So this isn't some funky company that's about to collapse.
Yeah.
The market just doesn't understand how good iron ore has gotten, and that instead of getting discounted, Fortescue's paid in full for the 58%. So this stock could be a triple bagger collecting this dividend.
Yeah, incredible. John, we're going to have to leave it go at that because we're out of time. I knew you were very excited about this. I wanted to hear about it. I wanted our listeners to hear about it. I want to thank you very much for taking the time to tell us about it. And we'll look to have you back on when you have another great idea like this. Thank you so much for being with us today.
Thank you for the honor of being your guest.